So we will continue our discussion on economy. We have started off with the module taxation, and so far we have completed around 5-6 lectures in that, and we have discussed almost all the important concepts related to this particular module. Now in this session, what I'll be doing is I'll be talking about various tax disputes with MNCs. Okay, so mainly we'll talk about the tax dispute with Vodafone. So there are two cases, two important cases. The first one is actually indirect transfer of assets case that we will discuss. Then towards the end of that, I'll briefly talk about BEPA, Bilateral Investment Promotion and Protection Agreement, that we have with Netherlands. Especially I'll discuss because that is specific to this particular case. And then we will talk about transfer pricing case that also related to Vodafone only. There are many companies which are involved in this transfer pricing. I'll talk about the entire details of transfer pricing and what is a case also I'll discuss, because Vodafone case is actually more highlighted. Okay, and then associated to that we will discuss about the concept of BEPS, base erosion and profit shifting, and then we will talk about the concepts of DTAA, double taxation avoidance agreement, in connection to the shell companies, one of the method of avoidance of taxation. And connected to that, we'll also discuss about treaty shopping, which is actually the misuse of DTAA. And if time permits, I'll talk about the OECD initiative of BEPS project. Okay, so and how it is concerned India, all those things we'll discuss, and what are the action plans from that project we implemented. Everything will be covered towards the end if I get time. Okay, so let's get started. We'll start with indirect transfer of assets case, Vodafone case. Okay, so indirect transfer of assets case, this Vodafone case. See, there is a company, the name of the company is Hutchison Telecom International Limited, HTIL. Okay, so this is one company, and this company is actually the owner of another company named CGP. Okay, so it is commonly known as CGP. The actual name is CGP Investment Holding Limited. Okay, so this is the actual name of the company, but when we discuss about this case, we'll generally talk about CGP only. And this company is actually located in Cayman Island. Okay, so this company is actually located in Cayman Island, and this company is the owner of Hutchison SR Limited. Okay, which is located in India. Okay, so Hutchison SR Limited, and that was located in India. See, in this company, CGP is having 67% of shareholding. Okay, so 67% of shareholding is with CGP, and CGP is actually owned by Hutch. Okay, so effectively the owner of this company, Hutchison SR, is actually Hutch only. Okay, so and if you remember that there was a very big brand at that time, Hutch, and advertisements, logo and everything was related to Hutch only. Okay, so it was actually Hutch was the owner of this company. Now there is another company, that is Vodafone NV. The company name is Vodafone NV, which is located in UK, and their subsidiary company is Vodafone International Holdings Limited. Okay, and which was located in Netherlands. That's the reason why I told you I'll discuss specifically about Netherlands when we discuss about BEPA, Bilateral Investment Promotion and Protection Agreement. Okay, that we have with Netherlands, which is having importance related to this case. Okay, so we'll discuss that. So these are two companies, and the deal took place between this company, which was located in Netherlands, and this company CGP. So CGP is actually the owner of Hutchison SR Limited. So CGP sold the entire share that is with them to Vodafone International Holdings Limited. Now you can see here, the buyer is located in Netherlands, that means some other country. The seller is located in Cayman Islands, that is also some other country. So the deal is between two countries, two foreign countries, and the deal took place in Cayman Islands. Okay, so the deal was in Cayman Islands. And the Vodafone paid 11.2 billion in this deal in 2007. Okay, and now you can see what is the problem going to happen. See, the assets of CGP is actually located in India, but the deal took place in Cayman Islands. So their argument, the Vodafone's argument, is actually the deal is between the two companies which are located in foreign countries, and the deal happened also outside India. So there is no question of taxation or any other liability between two countries. But what happened is later in 2011, see, after this deal, the name of this company, the Hutchison SR Limited, is actually changed to Vodafone, and Vodafone started operating in India. So here what happened is after this, IT department sent notice to Vodafone by saying that there was a capital gain which was made in this transaction, and we have already discussed about capital gains tax. So you are supposed to pay capital gain tax, and since the deal was in 2007, this case is coming in 2011, so 4 years you haven't paid capital gains tax, so you have to pay capital gains tax, plus there will be a penalty, and for these 4 years you are also supposed to pay the interest, and it was estimated around 11,000 crore. So now the government sent notice to Vodafone that you are supposed to pay capital gains tax for this transaction, and you are supposed to pay 11,000 crore. Now you already know what is capital gains tax, which we have already discussed in one of our previous module. So you buy something and you're selling something, during that course of transaction, if you have made some gain, you have to pay capital gains tax. So actually capital gains tax is supposed to be paid by the seller. That means here, who made that capital gain? Hutch actually bought another company in 2003. At that time I think it was BPL, okay, and in 2003 Hutch bought this company, and in 2007 Hutch is actually selling, right? So who made the capital gain? It is the Hutch who made the capital gain. So capital gain tax is actually paid by the seller. But you know, as per convention, it is not the seller who is paying the capital gains tax, CGT. It is a buyer who will pay. See, actually seller has to pay because seller is getting that capital gain, but buyer will pay, but buyer will not pay it from his own pocket. What the buyer will do is, during the time of transaction, they withhold that amount that you are supposed to pay as capital gains tax, because you know at what price it was bought by Hutch, and you know at what price this transaction is going to happen. So you know the capital gain and you know the capital gains tax, so you can withhold that amount, and the seller is not paying, the buyer has to pay as per convention. Not in India, it is an international convention. So the liability is actually with Vodafone, and that's the reason why the notice was sent to Vodafone. Okay. Now then what happened? The case went to Bombay High Court in 2011. The case went to Bombay High Court. The Vodafone's lawyers, or the Vodafone argument was like this: we did nothing in India. Every transaction, the transaction was in some other country. It was in Cayman Island, and between the firms of two countries, and we have nothing to do with India and nothing to do with India's tax system. Okay, so we are not supposed to pay CGT. That was the Vodafone argument. But the IT department argued that assets are located in India, and the transaction, whether the transaction happens somewhere else, it doesn't matter, because assets are actually transferred. That means you are actually buying and selling, or you are there was an asset which was bought and sold. Now whether the transaction, the payment made in some other country, it doesn't matter. See, something is there in some, let's suppose you have something in Kerala, the payment was made in Delhi or some other place, it doesn't matter, right? It can be online, it can be offline, you may talk over phone, you may not even meet, it doesn't matter, it hardly matters. Where the asset is located, the asset is located in India, and that was a logical argument of IT department. And what happened is, in 2011, they won the case in Bombay High Court. The Vodafone actually lost the case in Bombay High Court in 2011. Obviously, they appealed in Supreme Court, okay, in 2012, and Vodafone won this case in Supreme Court. Now, how they won is what I'm supposed to tell you now. See, there are two ways in which you can win the case. You can win the case on technical ground, and you can win the case on merit. On merit means if you have not done anything, then you can, and if you are punished, okay, obviously you can win. And otherwise, if the procedure followed by the punishing authority or this IT department is not correct, on technical ground you can win. So here, actually on technical ground, the Vodafone won the case. So what happened is Vodafone's lawyer asked the IT department, under which law, which act permit you to impose capital gains tax? Okay, and the reply was, so what they said is under Income Tax Act 1961. Okay, then the lawyers asked, in Indian Income Tax Act 1961, where is the provision? You show me the provision that in case of transfer of assets that you need to pay CGT. See, what is mentioned in that Income Tax Act 1961 is if items are bought and sold in India and if there is a capital gain, you have to pay CGT, capital gains tax. But here it is a transfer. One company is transferring their assets to some other country and the payment is done some other place. Okay, so they are saying it is not mentioned about the case of transfer in the Income Tax Act 1961. So if nothing mentioned, if that is not mentioned, now you are not liable to pay tax. So this was the ground in which the Vodafone won the case, and Supreme Court actually directed the government, the IT department, to pay whatever tax they paid, because after the Bombay High Court verdict, they paid some amount as the tax, even though they went to Supreme Court. And not only this tax that Vodafone paid to the government, but also you have to pay interest, because you imposed interest on them. Now Supreme Court imposed interest on government. Okay, so this is what actually happened, and this is how they won the case. Now what the government did, see, the problem here is that clause, the transfer of assets, was not there in the Income Tax Act 1961. So in 2012, government amended this. So in 2012-13 budget, the government amended Income Tax Act of 1961, and they have added this provision that if the assets are located in India and if it is transferred or if it is bought and sold anywhere, there has to be a capital gains tax. Okay, so the law, now this was amended in 2012-13, and what the government did is it was given effect from 1962 1st April 1962. So the government amended now in 2012-13 and gave effect from 1962, and this is what we call as retrospective taxation, giving effect from previous date. Okay, even though it is amended here now in 2012-13. See, this is not possible in criminal cases. In criminal cases, if there were no law existing at the time of a particular offense, you cannot convict that person under that particular rule. Even after the offense, if there is a new law which was coming into existence related to that case, you cannot use that law if the offense happened before that law. But that was in criminal cases. You cannot give this retrospective effect in criminal cases or in criminal laws, but it can be done in case of civil law, and that is what actually government did. Now see, this was very severely criticized at that time. See what the government is going to get. Government is going to get around 11,000 crore from Vodafone, obviously, and from some other companies. Okay, you'll get something else because some other companies are also done this kind of things. Okay, because many companies will do this is basically for tax avoidance. Okay, not tax evasion. Tax avoidance, tax evasion, the difference you already know. Using the loopholes in the law, you are reducing the tax liabilities, your tax avoidance legally, but misusing the provisions of law. Tax evasion means you are not even showing your income. Okay, so all those concepts that we have discussed. So it was estimated around 40,000 crore you will get as the tax if you impose this and if you go with retrospective transaction or taxation. Okay, so the problem is you hardly get this 40,000 crore, but you're compromising your integrity. Okay, so it's a kind of breach of trust, and this is severely going to affect the business environment. So nobody is now going to invest in India. So effectively, if you look into, even though government is going to get this 40,000 crore, there may be some companies who are ready to invest in India in a big way, and you might have got good amount of tax from them. Now they stopped investing in India because of this kind of taxation. Okay, so retrospective taxation was severely criticized at that time. So I hope you understood about what is retrospective taxation. We have in fact discussed this already, but in connection to this also I'm just covering it. Okay, now Vodafone is supposed to pay what, this 11,000 crore because government did something amended and it is there in the rule book, so you have to pay. Now there is no possibility that you can go to Supreme Court, because on merit now you can't win the case. On merit there is nothing in their side, because it is clearly a tax avoidance. So if the law is amended and if it is given effect from 1962, you are supposed to pay. There is no point now you go into High Court or Supreme Court. You have to pay tax. So what Vodafone did is, Vodafone said, we are ready for negotiation. We can't pay this 11,000. We are ready for negotiation. Now, at that time, there was one more case also which was going on. That was transfer pricing case. Now, together, government is estimated around 20,000 crore you are supposed to pay. So, what Vodafone said is, we are ready to negotiate together these two cases. So, asked government how much we need to pay for this 20,000, by what amount you can settle this case. But what government's reply was, now the case related to transfer pricing is going on in Bombay High Court, so we won't discuss about that, we won't negotiate on that, we will negotiate only on this indirect transfer of assets case, which is related to this 11,000 crore. So there the talks actually stopped and the case went to International Court of Justice and the case is pending over there. Okay, that is the situation. Now, one more thing is related to retrospective taxation. Actually, after imposing this law, after amending this law and given effect from April 1st, 1962, after this, a committee was appointed. We have already discussed this committee. You know that the chairman was Parthasarathy Shom. So, Parthasarathy Shom committee appointed in 2012 and related to retrospective taxation. So even this committee also said this was not desirable. This is not desirable. So not desirable. Okay, and what the committee said is, you can give a prospective effect. That means from now on you can impose this, but not retrospective effect. Okay, so go for prospective effect and not retrospective. I hope you understood what is retrospective taxation, given effect from a previous time. Okay, and then one more thing that the committee recommended is, in case if you're going for retrospective taxation, you may consider, but it should be in rarest of rare cases. Like we are giving capital punishment, but that should be in rarest of the rare cases. Okay, so it may consider in rarest of the rare cases, and in the opinion of this committee, Parthasarathy Shom committee, this is not a rarest of rare case. Many companies will do this by misusing the legal provisions. Okay, so many companies are doing this for tax avoidance, so this is not a rarest of rare case. And then if it is imposed, in case if it is imposed, there are some suggestions also. In case if imposed, it should be imposed on seller. Imposed on seller. Now, what is the logic why it should be imposed on seller? See, who's gaining the capital gain? It is a seller who's gaining the capital gain. And you know here, the Hutch made the capital gain because Hutch bought another company in 2003 and they are selling it in 2007. So Hutch made the capital gain and Vodafone have nothing to do here. They have actually made the entire payment. So who is avoiding the tax here? It is Hutch only who's evading the tax. Not evading is illegal. Illegally you are reducing the tax liability. Here it is legally by using the loophole. So I should say it is tax avoidance. So who is avoiding the tax? It is Hutch. So it should be imposed on the seller, not on the buyer. That is the first thing. Secondly, there should not be here, in this case you can see government is imposing the penalty and interest also. So there should not be no penalty and no interest. See, what is the logic of this penalty? The deal was in 2007 and you sent notice in 2011. So you identified this in 2011. So it is whose mistake? The deal was in 2007. So you should be knowing this. And everybody know that Hutch was now changed to Vodafone. Why you don't know about this? So whose mistake it was to delay this? Okay, so it is your mistake. So you cannot impose penalty and interest upon these kinds of deal. It is your responsibility to catch if there is anything wrong which happened in 2007. You should be catching it in 2007, not in 2011. And it's your mistake and not the mistake of Vodafone. Okay. And then what happened after imposing this retrospective taxation? Now actually Vodafone have to pay. There is no other choice. So Vodafone went to this BEPA. Okay, so BEPA is actually bilateral investment promotion and protection agreement, which was signed between India and Netherlands, but they didn't get any relief from here also, and after that they went to International Court of Justice and the case is pending over there. So there's the current case. Okay, there's the current situation. Now we'll go to the next case, that is transfer pricing case. So what I'll do is I'll discuss the entire details of transfer pricing, and I'll tell you what is transfer price and how the tax avoidance is actually happening here. Every logic will be explained, and then we will move on to the Vodafone case related to transfer pricing. Okay, so transfer pricing case. See, first we'll see what is transfer pricing. Transfer pricing is actually buying or selling inputs or assets by a company to its associated company in another country. Okay, so you're buying or selling inputs or assets by a company to its associated company. It can be a parent company, it can be a subsidiary company, or two connected company. Okay, anything is possible. There has to be some association between that two companies in another country. So the deal will be between two different countries. So two companies will be located in two countries. I'll tell you how is it done and what is the advantage of all these things and how is it actually helping you to avoid tax. Everything we'll discuss. Okay. So this is actually transfer pricing. And what do you mean by transfer price? The transfer price is actually the price at which this inputs or assets are sold. So the price at which such inputs or assets are traded is called transfer price. Okay, so I hope you understood transfer pricing. See, transfer pricing is legal. There is no problem in transfer pricing because you can see here in the definition itself, you are buying and selling assets or inputs from some other company, which may be a parent company, subsidiary company, associated company. What's wrong in it? It is perfectly and purely legal. But what is the problem? Transfer mispricing is the problem. The deal may be at one rate and you may manipulate and by saying that the deal happened at some other rate. What is the advantage? We'll see. Okay, within short time we'll see that. And this will happen only between, associated companies. Do you think it will happen between different companies? It won't happen because company A may sell something to company B. So they will only try to show the actual amount. Otherwise, there will be tax liability and burden between two companies. Okay. So it will, the transfer mispricing won't happen much in case of different companies. It will happen only between associated companies. Okay. Now, one more concept. In such deals, okay, I'll explain what is it. See, there is a company A, and another company B. These are related companies. It can be subsidiaries, associated companies. Okay, so what happened is company B, let's say company A is located in India and company B located in any tax haven, maybe Cayman Islands or Mauritius or Singapore. Okay, Mauritius. So what company B will do is company B will sell some raw materials or inputs to company A. Okay, so raw materials are sold to company A at a price. Okay, let's suppose this actual price is $10 lakh or $20 lakh, whatever it is. Okay, so it was sold at this rate, or this is the original rate, but what will happen is they manipulate this price. Okay, and they will say that this transaction has actually happened not at 10 lakh, it was at 15 lakh. Okay, so what the company A, which was located in India, will do, company A will transfer $15 lakh for this inputs. Actually, you're supposed to pay how much? 10 lakh. So the worth of the input is actually 10 lakh. If you're selling it to some other country, you are getting 10 lakh only. They will only pay 10 lakh. But if you're paying it to associated company, you can manipulate and you're getting 15 lakh. Why it is done? What is the advantage? See, actually this extra $5 lakh you are transferring from India to some other country. So this simply you have transferred. Otherwise, if this 5 lakh, if you need to transfer as a profit from India, see what you need to do. If it is profit, if you're showing it as profit, you have to pay corporate income tax, which we have already discussed, you know that, dividend distribution tax, and all these will be coming around 50%. So for this $5 lakh, you have to pay around 2.5 lakh as the tax. But if you are showing it as purchasing of raw material, okay, that means you are importing from your parent company or some other company, you have to pay only customs duty. Okay, and for these kinds of items, most items, it is hardly 6 to 7%. So you can see for this 5 lakh, if you calculate at 6%, you may have to pay $30,000 as the tax. So you see the huge difference between these two, and that is the reason why you're doing this, and effectively you are shifting the profit to some other country. Now, what is actually happening here? How is it affecting India? See, in India, when the raw material cost is high, they are showing the raw material cost is high. So what will happen? The profit of the company will come down. When the profit of the company will come down means the tax will come down. So in this way, it will affect the country. Okay. See here, this company is now in very low profit and this company is in very high profit. This 5 lakh is also added as the profit of this company B, and here this profit of company A is actually shifted. So effectively A is showing very less profit. So very less profit means you need to pay very less tax. Now here, what is the problem? Here also you need to pay tax, but the tax in Mauritius, you know how much you need to pay. So for that 5 lakh that you shifted from India, you need to pay very small amount than what you paid or what you're supposed to pay in India. And this is the logic of transfer pricing, or I should say transfer mispricing. Okay, so this is how they are using it. So transfer pricing is one of the means to avoid tax. I won't say it is again evasion. Evasion means you are illegally not paying tax by not showing income. Here you are showing everything, but legally you are doing it, and it is clear case of tax avoidance. Okay, and it has to be checked. And for that, there is a direction. The direction is like this. In such deals, the transaction should be at arm's length. That means arm's length trade means it's like this only. How much you charge if you're selling it to some other country, some other company. Okay, it should be the same rate in case of associated company also. Then you can check this. Okay, so in such deals, since there are chances of mispricing, so as per taxation rules, such deals should take place on the basis of arm's length relation principle. Okay, what is arm's length relation principle? That is, such deals should be made at a price which might have charged from unrelated entities. Okay, so if the companies are not related, how much you will charge? Exactly the same should be charged from related company or associated company also. Then you can effectively reduce the chances of transfer mispricing. Transfer pricing is okay. The price at which it is transferred is also okay. It is purely legal. But transfer mispricing means you are shifting the profit. Okay. And one more concept I need to discuss here, that is BEPS, base erosion and profit shifting. See, what is this base erosion and profit shifting? It is actually tax base is reducing and you're shifting the profit. Exactly what I've discussed in case of transfer pricing or transfer mispricing. That is one of the means of, BEPS, base erosion and profit shifting. So it is clearly again a concept related to tax avoidance. Okay, so let me write it down. It refers to tax avoidance strategies of MNCs to reduce tax liability in most countries by shifting their profits. See, actually the profit is the tax base, right? So when you're shifting, the tax base is actually reducing, or I'll write in bracket tax base, to low tax jurisdiction. That means I'm talking about countries like Mauritius, Cayman Islands, Singapore, etc., the tax havens. Okay, so what we have discussed, transfer pricing before, it can be used as a means of BEPS, right? It can be simply used as a means of BEPS. So transfer pricing is one of the means of BEPS. Now other means is actually through shell companies. Okay, so shell companies means you will just start a company in tax haven, and every deal will be between those two countries, and you can misuse the provisions of DTAA, that is double taxation avoidance agreement, by saying that you have paid tax in that country and you're not supposed to pay it here. Okay, so related to that, there are some other laws which we have brought in, limitation of clause benefit and everything we have already discussed before, so I'm not getting into the details. So this misuse of DTAA is what you call as treaty shopping. Okay, so let me write it down. Under BEPS, MNCs usually invest in foreign countries through their shell companies located in low tax jurisdiction. Okay, so it is also called treaty shopping. So also called treaty shopping. So treaty shopping is basically or effectively the misuse of DTAA, double taxation avoidance agreement. Okay, now through transfer pricing, how can you avoid the capital gains tax? I'll show you one example. So capital gains tax is actually imposed on buying and selling of assets or shares. Okay, so let's suppose you purchased purchase of share at 100 crore and you are selling sale of share at 150 crore. Okay, so what is the capital gain here? So here the capital gain, you can see here, that is 50 crore. So you are supposed to pay capital gain tax upon this 50 crore. Now how to avoid this? Okay, how to avoid this? What the companies can do is, you bought at 100 crore and you will sell it to your associated company by showing you are selling it at 110 crore. Actually it is 150 crore and you are saying that you are selling at only 110 crore. See, this will not happen with different companies, because you won't undervalue that, because you are getting the fund and you cannot undervalue that. So in case of associated companies, this can be done. So here, now what is the capital gain? 10 crore. So what is the amount as you need to pay as capital gains tax? You need to pay for 10 crore only. So that's how you can avoid the tax liability, okay, by using this kind of provisions. Now what is the Vodafone's case, transfer pricing case? See, Vodafone's case is this. There is a call center. Okay, so Vodafone Teleservices Limited, located at Pune. Okay, it was sold to some other subsidiary company, some associated company in Mauritius, and actually the price was undervalued, just like what I've told you in this case. If it was 100 crore and the actual worth is, let's suppose, 150 crore, it was undervalued and have shown as 110 crore. Okay, so it is clearly a strategy of tax avoidance, and everybody know that. The income tax department also know that. So what they said is, it is clear. Okay, you have transferred, so the actual worth is 150 crore, even though you are showing 110 crore. So effectively, this difference of 40 crore okay, is actually a kind of loan that you have given to them. Okay, so if you have given loan to the other company, your subsidiary company, you are taxable. Okay, and there was no logic in this, and they went to Bombay High Court, and they failed in this case, again on technical ground, because this provision was not there in any law. So under technical ground, they actually won the case in Bombay High Court itself. See, in the previous case in Bombay High Court, Vodafone lost the case and went to Supreme Court. Here in Bombay High Court, they won the case, but IT department, at that time the government have changed, NDA government have come, they decided they are not going to appeal against this, and they were okay with the provision, because already Parthasarathi Shom committee and all recommended that whatever happened in 2012-13, it was very bad, and it actually affected the entire business sentiments, and this government interest is to basically promote business, make in India campaign, and all these were there, so they want to attract the companies, so they decided not to appeal. Okay, so this is all about the case.